Hello, everyone. Thanks for joining us for this session of Fraud Fighters Virtual Summit, 5 top fraud challenges facing financial institutions and how to address them. I'm Ross Warnoff, Marketing Director at Unit 21. A couple quick housekeeping items before we get started here. First, this session will be recorded and it will be available here immediately after this session. And second, because these sessions are 30 minutes, unfortunately, we won't have time for a dedicated Q&A session at the end here, but we encourage everyone to submit their questions throughout the conversation, and we'll do our best to answer them in the chat area as they come in. Great. With that, I'd love to introduce today's speakers. I'm super excited for the group that has come together here, a lot of diverse perspectives on this topic. Haley, why don't you kick us off?
Hi, I'm Haley Wyndham. I'm the brand ambassador for Mission Omega and also the host of the Banking on Fraudology podcast. Very excited to be here today. Thanks for inviting me.
Wonderful. Well, we're happy to have you. Donna, why don't you go?
Hey, thanks, Ross. Donna Turner, retired fraud executive from Bank of America, also retired COO for Early Warning Services. Currently serving as a semi-retired advisor in residence or corporate fraud professor for EY.
Wonderful. Thanks, Donna. Scott.
Hey Ross, I'm Scott Harkey. I'm the EVP of Financial Services and Payments at Endava, where I work with some of our big financial service customers.
Great, thanks, Scott. And last but not least, our resident fraud risk expert, Alex.
Hey Ross, hello everyone. My name is Alex Fabosovich. I'm the head of Fraud Risk here at 2021, fraud prevention practitioner for the past 15 years.
Great. Well, with that, I'm going to go ahead and get out of the way. Alex is going to be leading this conversation. Alex, why don't you go ahead and get us started?
Yeah, absolutely. So first of all, I hope everybody has been enjoying the virtual summit. I know we have a lot of speakers and a lot of great content, so I hope you're not tired by listening to us all day. But let's kickstart this session. And today we're here to discuss the 5 different trends that's happening in the market right now. And I want to start with my point of view on the general landscape and what's going on. And I will talk about a few different points. So on one hand, when I meet traditional financial institutions, one thing that really bothers me when I speak to those banks and credit unions is that I see a lot of focus still on monitoring on the transaction level. So, the same practices that we did in the 90s, in the early 2000s, still monitoring the transaction level, still trying to understand whether or not the customer is the one who did the transaction. And while I do understand that third-party fraud is still very relevant and we, as a core offering, need to protect our customers, this is not the only risk that banks and credit unions are exposed to. And the risk is first-party fraud, and we will touch on that while we proceed this session. On the fintech side of things, when I speak to fintech founders, especially very early stage companies, I see a lot of focus on onboarding. So we've seen a big shift from onboarding at all costs during the pandemic. Everybody was bringing as many customers as they could, which led to probably the biggest fraud trend that we've seen in the past 5 years, from PPP loans and unemployment fraud and all the fraud that happened as a result of COVID-19. But basically now we are seeing those fintech companies focusing on smart growth, and they putting a lot of resources into KYC, into KYB. And I see this assumption over and over again. Funders think that if they have a strong KYC process or if they have a strong KYB process, their fraud problems will end there, which is not true. And they don't focus enough on continuous transaction monitoring. So in general, I think that with this session, we will cover why first-party fraud is on a rise and how to address it. But we also break down the 5 different vectors of how fraud is happening, different channels, different type of payment rails. So let's move forward. First-party fraud is on the rise. And I think as fraud prevention specialists, we need to ask ourselves why a certain phenomenon is happening, why first-party fraud is on the rise. Some will say, It's a generational trend. It's a Gen Z problem. People have less morals. People have less standards of moral behaviors, which might be true, but we cannot focus on that. The simple thing, the simple explanation to why first-party fraud is happening is crime pays. You can easily execute fraudulent activity today with pretty much any financial institutions, and chances are that you will suffer any consequences or repercussions are very, very minimal. And this is why we see first-party fraud is happening. So if I can do fraud from sitting at my home behind my monitor, working whatever fraud scheme I'm trying to execute without needing to actually have a 9-to-5 job, then why will I go and have a 9-to-5 job? We've seen kids, 18 years old, 19 years old people making $500,000 cash, and nobody is chasing them. Nobody is catching them. And there is no motivation for them to keep an honest lifestyle when they can easily do fraud. So I'm interested to hear the point of views of our guest speakers today. But Haley, let's start with you. How do you see first-party fraud today in the market?
Yeah, I agree with you 100% on everything that you said, from the point of view that the financial institutions were still kind of in that analog approach to how are we going to prevent this or get in front of it, but really we're not understanding the full concept of, our people or our customers are participating in these transactions. And so we kind of are at a catch-22 of have we been enabling these customers to continue to do this because we make up excuses and we want to provide the best customer service, but in the long run, all we've done is hurt ourselves in the end. The risk, like you said, is not on the fraudster at all. It's on us as the institution, because we have to worry about our reputation and how are we, going to be viewed in the public eye if we stop a transaction from processing, and then what may be said about us on social media. So completely agree. But what I'm seeing, especially in that Gen Z world that you're talking to or that you referred to, is the Reg E dispute process and that abuse in the provisional credit system, where basically they come in and they dispute a transaction. And if you can't finalize your investigation within that 10 days, you've got to provide that provisional credit for whatever it was that was disputed. But in the end of your investigation, if it is determined that that customer participated in that transaction, 9 times out of 10, the money that you refunded is already removed from the account. So then that becomes a write-off. And then are we classifying that correctly? Are we just charging that off as a write-off charge-off account? Or are we classifying that as a fraud loss due to someone was actively trying to defraud the institution? Was it that intent of that account opening from the very beginning? So we've got that to consider, as well as synthetic identities and identity theft at account opening. There's just so much that's happening, and it's hard to keep up, especially when you're at a smaller institution.
I think you brought up a great point. So, and we see it quite often. We'll see fraudsters, or let's call them people who intentionally will go read your terms and conditions, and then will find a way to abuse your own terms. So question I always ask, it's usually fintechs, is how do you bake into your product offering, into your terms and conditions, that if you have a customer who is, filing disputes, and you find at the end of the investigation that they are the one who did the transaction, how do you build in your terms and conditions the fact that, hey, if you keep doing that, we will have to shut down your account. We will not allow you to use our products, to use our services. So that's a great point. Thank you so much. Scott, how about you?
Yeah, I would definitely agree with Haley. The disputes is one of the things we see the most of. I think other things, though, especially as the economy kind of tightens and people are tighter on money, is some of the kind of intentional overspend and over leveraging credit. Certainly, running up high balances on things people never intend to pay, taking lines of credit and then disappearing from those. That's another one of those things that, again, I think it's somewhat economy driven. But we've seen organizations effectively monitor, do better with detecting that type of fraud by looking at more broader patterns of usage. I think, you said it in your opening, but the transactional view of things is necessary. but also looking more holistically at, is that something the customer would normally do? Does that pattern feel different? Are they suddenly requesting multiple lines of credit and they've never done that before? Like, should we have a conversation with them about that? So kind of in the same vein of as banks and credit unions have tried to increase customer service, make things more digital, make it easier for customers to do things, it can't forget to do the other side of that, which is also to follow up on things that maybe don't look normal, right? You can make it easy, but also then require follow-up or require interaction for things that feel out of the norm. And I think that could be one of the most effective kind of low-tech things. Is just, getting a hold of the customer and saying like, can you help me understand the situation? Why are you kind of applying for these multiple lines of credit, or why do you have these multiple products going on? I think data sharing is another thing that we can talk about more, but that plays into that a little bit as well, because often it's a line of credit at multiple institutions, or is taking out some sort of product at multiple institutions. And if you don't have some sort of shared way of seeing that activity, then it can be hard to detect on an individual institution basis. So that's where some of the data sharing stuff can help as well.
Thank you so much. That's a great point, and I really like the view you presented about the economical point. There is a supply and demand even in financial crimes. Like if you think about it, let's say 6-7 years ago, if I wanted to start doing fraud, I would probably have to, go into the dark web, right? Most folks have no idea what the dark web is. They don't know what's a Tor browser. They don't know what's an Onion. They have no idea how to join Eastern European forum where to buy illicit goods. But now all you have to do is to download something like a Telegram, join a group, and here you go. Everything is available for you. All you need is a wallet with a couple of Bitcoins or any other cryptocurrency that they want to use, and that's it. You have access to unlimited amount of illicit goods. So thank you so much for that. Donna, I'm curious to hear your point of view on that.
Yeah, I think, Haley hit on the emphasis on experience, right? And the reason why that's our tall bar, and Scott hit on the emphasis of kind of looking across again with let's get the onboarding, let's get the pull through, minimal fiction, right? All that points to ultimately at the transactional level, the economics are misaligned for anybody in financial services to really take an aggressive view on first-party fraud. If you think about card transaction data, the liability sits with the merchant. If you think about ACH transactions, right, it's very easy to just say, hey, I didn't do that, and they return the ACH. So I think what we're going to start to see here, and you've already seen it from Visa with the compelling evidence rules, is this shift to kind of bring back some of that economic balance in these transactions. So merchants, acquirers, chargeback processors are investing in the API calls and stores to aggregate representment packages. So you're going to see more of the pay by bank providers get more aggressive with their WSUDs when they suspect first party fraud. So you're going to see this in turn is going to change the economics for the financial services sector. And I think we're going to finally see a shift to applying some of the technology we have in collections and fraud elsewhere in disputes. So think about in collections, we've always had best treatment modules. We have credit scores, we have fraud scores, right? We don't have true robust probability of payment or probability of abuse scores. So I think we're going to finally see this convergence of technology on the financial services side of this, as it's going to lag what's happening on the merchant or the pay by bank provider side of this to bring these economics back in balance. And then I think you're going to start to see more user friction before they just accept that dispute and throw it back over the wall, because that's what the current economic model would tell an intelligent financial services participant to do.
That's a great point, and I really love the fact that you mentioned WSUDs. Do you care to elaborate a bit more for the audience who are not familiar with what WSUD is?
So working with a client, right, they had a question around, they're in a pay-by-bank solution. They had a question, they suspected a typical what a merchant sees, right? Upwards of 75-80% of what they saw as disputes for unauthorized, they believe that they had all the data elements to show that that really was true party. And in this case, working with their hosting financial institution, implemented the WSUD, I never get the acronym right, Written Statement of Unauthorized Debit, which is basically under the ACH rules an opportunity to cry foul. Listen, we have all this information that says this really was Donna, and this really was an authorized ACH transaction, and we would like the money returned to us. I know in my days as a banker, you didn't see this really used much, but again, with the advent of pay by bank, when you're seeing ACH kind of take on a broader role across payments, again, these pay by bank providers, their sponsor banks, et cetera, are now motivated to invest in the operational processes, just like representments on the card side, to try and stem back the financial pain they're taking from abuse.
That's a great insight. Thank you so much for that. So, and I started saying a couple of months ago that in my opinion, what we've seen starting 2013 up to 2023, what I call the KYC boom, is now over. I think that industry of KYC evolved dramatically, and the KYC products today are very amazing, and they're way better than what they used to be in 2013. But what we will see from this year, and I hope for the next 10 years, is what I call the consortium boom. Is basically how do we take networks of global data, and we safely share it between different financial institutions to flag those first-party fraudsters, to be able to say that person might have been involved in a first-party fraud in 5 different banks. You should consider twice before onboarding him or offering them any type of high-risk product. So thank you so much for that. So while first-party fraud is obviously on the rise, we also see rise of scams performed by bad actors. And like I said in the beginning, it's our responsibility to protect our customers and keep them safe. But if our systems by design are working to detect if a transaction wasn't made by the customer, how do we detect scams? How do we detect a transaction that is actually being made by the customer? And most of the scam, unfortunately, is happening outside of the financial ecosystem. It happens on the chat rooms, it happens via text messages, it happens on social media. The execution of the scam is in the financial ecosystem. So how do we detect that? And I would like to touch a bit about that. Scott, I would love to hear your point of view on how do you see scams today in the market?
Yeah, I think there's 2 main things driving the increased number of scams and kind of how critical a problem that's become to solve. One is the availability of data, right? The sheer number of data breaches and the scope of those data breaches continues to increase. Even recently, all this stuff with a bank that I won't name, but just say the proliferation of data, not only from them, but all of their partners that now is out there in the ecosystem. It just continues to see more. We continue to see more and more data out there, which gives the fraudsters the tools to work with, right? I think you combine that with the advancements in AI, everything from voice replacement to video replacement to the ability to automate the creation of phishing messages that are used. Just the acceleration of the technology side of enablement continues to drive just more and more of these scams as well. And it's getting harder and harder for people to detect what is a scam and what isn't. I think one of the biggest implications to that is to some of the real-time payment systems around the world that are launching. And a model of some of those systems revolves around the idea of request for payment and the idea that the financial institution has to ask the customer to confirm essentially that they are going to make this payment. Well, it's a real challenge for financial institutions to design that messaging that doesn't just end up looking like a scam, right? How do you teach in consumers the difference between a legitimate request for payment from an institution versus a scam and kind of finding the space between that? So I think that's a real example how the current lack of a real solution to scams is actually slowing down the advancement of some of the newer products and services in the industry because of the focus around that. And there's been a lot of legislative conversations and other things that are happening around that. So I think that's one of the big things. I think the other piece of it I would say is people often talk about taking advantage of certain generations of people, whether it's older people or it's you know, kind of other dynamics. You know, scams are universal, right? Scams target old people, young people, you know, middle-aged people. It's easy to get taken advantage of by a scam. And while I think a lot of the conversation ends up being about, you know, an assumption of familiarity with technology or, you know, that being an element of it, they've gotten so sophisticated that it's not even really about that anymore. Certainly that group is susceptible to these things. But so are you and I've gotten, you know, attempted scams multiple times, and it took me a couple of questions through to get to discovering that it was a scam. You know, I'm you know, on high alert at all times, which is probably not the average person. But the sophistication's gotten really complex.
I absolutely agree. I've been following about what the lawmakers trying to do in the UK, where they pretty much trying to offer split liability between the sending and the receiving institutions for fast payment, and have both sides liable for up to 180 days in order to protect the customer, which is great. It can help, but my first reaction to this, well, this will bring first party fraud back up, because if I know for a fact that my bank will have to pay 50% back of everything I dispute 180 days back, I can keep sending you, Scott, money for 6 months, and then we can split the profit. Why not? You'll get half, I'll get half from your bank, get half from my bank. So why not to do that? Donna, I know you have a lot to say about the subject, so I'm interested to hear what
Yeah,
you have
dude,
to
we
say.
could probably spend an hour on this one. I think there's really a few key points, right? Kind of playing on what Scott just said. We've lost the consumer as a line of defense, right? We've built so much of our detection and prevention processes around consumer set alert, our ability to interact with the consumer to say did you do this, right? Well, now the consumer or the victim is part of the execution of the scam. So we've lost that critical layer of defense we've built around and have relied upon. Having said that, even when we are and often able to detect that consumer or that business is involved in a scam, it's extremely hard to, and I'll coin the UK phrase, right, break the spell, to convince them that they are part of a scam, that they are being duped. So I hope technologically what we're going to come and see is more direct technology that interacts directly with the consumer or the business to say, we believe you're being scammed. Google just demoed something recently around a phone-based thing. There's firms like Scamnetics. We're starting to see solutions, early stage solutions come to market. Can they scale? Are they sustainable? What's consumers' reaction going to be? But I think that's going to be the next wave of defense to replace what we've long relied on. Having said that, and you hit on this, right, with the QK example, and it's not just the UK, they've been at this for 10 years. Australia, Singapore, India, Mexico, Brazil, the Nordics, France, I could go on and on, are really getting organized around fraud, not just these authorized push payment or scam, but they're getting organized geographically around fraud, forced voluntold type across sectors, financial services, big tech, social media, telecom, et cetera, to come together and say, we have to work across sector in a very organized manner to beat back fraud. Having said that, the attack rates in the US, I typically say North America, because Canada's in the same boat we are simply going to rise exponentially, because these other geographies around us are getting very organized. This is a very lucrative business. These call centers continue to spring up. They don't downsize. So I think we're actually in North America, we're going to see this threat level grow exponentially over the next 18 to 36 months. And then, you know, what we're seeing now, we can learn a lot from the UK, right? We can learn not to repeat some mistakes. But what they're already seeing is a shift away from APP back to other types of fraud. So we have to prepare for that, right? They're never going to go get real jobs. So we not only have to get our act together here in North America, in the US, and get organized as a financial service, as a country around fraud in a cross-sector way, we need to do so in a manner not to be short-sighted and assume that APP is the only problem that we're going to solve for.
I absolutely agree, and I think you hit the nail on the head where you say we as a country. It's not enough if you have the 5 biggest banks put in effort into trying to stop that. It has to come from the government. It has to come from the federal as in orders, and it has to be built into how we build the rail guards to protect our customers. Haley, what's your opinion on this subject?
I know we have to be conscientious of our time, given our time slot. So I'll just say that I completely agree. Collaboration is going to be key across the vectors or the sectors in the financial world. It's going to require a multifaceted approach, combining the advanced technology, the stringent regulatory compliance, and that proactive monitoring strategies to mitigate those risks.
Absolutely. Thank you so much. Scott, would you be able to bring up the slides back, and we can move forward to showing the 5 vectors of fraud that we're seeing on the rise? Thank you so much. That's great. So for the sake of time, I know we only have a few minutes left, and I do want to cover this slide. What we showing you here is how we see fraud evolving in the next couple of years. And I think, Ross, it's just disappeared. If you can bring it up again. Thank you. So we detailed here the 5 different vectors, which are checks, ACH, account takeovers, business email compromise, and elder exploitations. I will go briefly over each and what are the key challenges. I think with checks, if you've been living here in the United States, you heard that it's everywhere. Mail theft is a nationwide pandemic, and as a result of that mail theft, we're seeing way more counterfeit, way more stolen checks in the market today. The way that technology evolved and the way that the tools that fraudsters have today in terms of how they can alter checks, how they can wash the checks, how they can use printers to print checks that looks very much original, making it very hard to detect those checks. And I think the way to address it is really with very sophisticated machine learning tools and having a good image analysis in place to be able to understand whether or not the check that is being deposited to your financial institution today is actually a legitimate check or not. With ACH, we touched this briefly when we spoke about first-party fraud. It's so easy to initiate an ACH and then say, "Hey, it wasn't me." Everything that the bank has to do is to return the ACH and then use the originator left holding the bank. Account takeovers, again, I think it's very important for financial institutions to start ingesting non-transactional data into their monitoring system. Understand what red flags can lead to account takeover. Understand the unique way their customer accessing their account. And if we see anomaly in the way the account is being accessed, flag it, especially if there is an attempt to make an outbound activity. Business email compromise causing a lot of fraud losses, especially when it comes to phishing, and then making sure that the person who is maybe a small business owner is now being compromised, and they say, "Hey, you might need to send your new contractor a payment, but to a brand new different bank account." I think the key to success here is understand how your business is paying the different vendors, and when you see a new payee that's being added to your business, know how to flag it and say, "Stop, you never paid this contractor to this bank account. Why are you doing this right now?" We touched on elder exploitation as well. I think it's our responsibility to make sure we see, and it's especially important for the elderly people, we don't see them as a victim. We need to see them as an asset, because this is how fraudsters look at those people. They see a nice old lady. She might be worth $500,000, $1 million. They see her as an asset. We need to understand if that asset is being drained out of its funds. We need to be able to raise this flag as soon as we can. We might not catch it on the first transaction, on the second transaction, but we need to find a way to catch it very fast and be able to flag both to the customer and to ourselves as a financial institution, "Hey, this person is being exploited." So I think for the sake of time, this is all what we have today. Ross, I will give the mic back to you.
Thanks, Alex. Thanks, everyone. I know there's a lot of information here, so we'll actually be sending these slides out to everyone who's live on the call after this session, so you can noodle on it a bit more and cover everything in detail there. So great. Well, moving forward, we've got in 5 minutes 3 great sessions that you can choose from. So the first is Chop Chop, stopping pig butchering scams, definitely relevant, related to the scams that we were just talking about. 2024 FinCrime Trends from LinkedIn's Top Voices in Risk and Compliance, and Unit 21's Rule Building Masterclass, a good way to think about how you might put together rules using transactional data, non-transactional data, and stop more bad actors. Also, if you'd like to learn more about fraud prevention, we've got a great demo where Alex himself will show how Unit 21 helps organizations of all sizes prevent fraud, and it's available all day in our demo lounge area. And last but not least, I'm excited to announce that we are in the midst of collecting data for our 3rd annual State of Fraud and AML report, and we're seeking to make this research the most informative set of findings yet. But we're really unable to uncover those insights without people like you contributing your thoughts and what you're seeing fighting fraud on the AML compliance front as well. So we encourage everyone, pull out your phones, scan that QR code. It takes only about 5 minutes to complete the survey, and that'll be produced as an industry report. So with that, I will kind of bid everyone adieu. I want to again say thank you very much to Haley, Scott, Donna, Alex for coming together today and sharing your thoughts, and hope everyone enjoys the rest of the virtual summit.